Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Badr Alam of CAVU Venture Partners. Badr, thank you for joining us.
Thanks for having me, Hall. Looking forward to it.
So what was your background before investing in early stage companies?
Well, I'd always been interested in brands from a young age, consumer brands. I was kind of the guy in middle school and high school who'd be buying the latest shoe or looking for the latest cool product. And really, I was always kind of drawn to the brand around those products, whether it was a Nike or a Coke or a Genera, whatever may be there. So always had this affinity for brands. And when I'd gotten into the work world, grew up in a pretty analytical environment, because very math and science focused, and tried to merge the two together. Ended up going into one of these investment banking programs, but focused exclusively on the consumer retail landscape. And as my career evolved, I moved from the investment banking side to really the investing side, working at private equity firms. Initially started focused on more multi-unit retail restaurant types of opportunities that were consumer facing. Some of the companies I'd invested in at that time were companies like Things Remembered, Bon Pain, 24-Hour Fitness, the chain of health clubs, but eventually moved over towards more kind of tangible products, starting with the apparel side, a company called Johnny-O. And that started my evolution into smaller companies, moving from kind of late stage control equity buyouts now to smaller high growth minority investments. And Johnny-O was an apparel business that I invested in probably 4 or 5 years ago. And that really kicked me off into this more early stage world. And then from there, I'd started just kind of investing in those types of businesses. And that led me to CAVU. I joined one of the founders of CAVU, Clayton Christopher, down here in Austin. And that brought me to today.
Well, great. So you've had a good track record and a good history in this space. What excites you right now? What do you find gets you really jazzed?
We're spending a lot of time looking at categories that we think will be the runway for the next 5 to 10 years in the consumer space. And that can even go beyond food and beverage. On the food and beverage side, I think there's some obvious ones that a lot of people are looking at, whether it's the plant-based world, companies like Beyond Meat that have gone public, given that world a lot of exposure. And there's certainly a set of companies and products and market environment that allows all tides to rise to the top there. That's an area we're going to continue to focus on and look at. But then other alternative areas, like I'm looking at the sleep category now. More sleep is a pretty big pain point for a lot of people in this country and globally. And there's some interesting brands that are coming out that are looking to capitalize on improving people's sleep and sleep patterns. So we start with kind of a macro thesis around where we want to focus our time and filter down from there.
Great. So for those investors who are thinking about investing in the consumer product goods space, what's your advice for them? What should they think about before they write that first check?
It's a few things. I think as an investor in the consumer product space is interesting because you can, given it's a product you can touch and feel, it's very easy to just kind of feel an affinity for a product. It's not a company that may be, for example, be in the healthcare services industry or oil and gas that you can't necessarily go and touch. So people fall in love with consumer products companies, but as an investor, you also got to realize that you're buying in at a price and you're exiting at a price. And so you have to be very clear-minded and specific around the front end, what the valuation is you're getting at, what the structure is, what the terms are, and what type of governance rights you have. And then on the back end, in terms of an exit, depending on how much control you have or you don't, you got to be pretty clear-minded about who your potential exit partners would be, whether it would be an IPO or a General Mills or a Nestle coming up and buying you, and really having a view on who that could potentially be that could exit the company. You also, from a big picture standpoint, have to make sure there's enough market size dollars and unmet need there for the runway of the business you're investing in. At the startup level, you don't have a fully formed corporation that's got decades of history that you can kind of look at and say, that's the direction this company is going. You're investing in a startup or a very early stage company. So you got to make sure there's enough market size from a dollar standpoint, but also growth standpoint for whatever you're investing in to be able to capitalize on that opportunity. I'm an investor in a company called Waterloo, and on the board of that company. Sparkling water is a $4 billion category that's still growing at mid double-digit growth rates, which is 3 to 4 times faster than the overall beverage category. And so you can kind of look at that market and look at the competitive set, which is really LaCroix, and say, well, there's plenty of opportunity for entrance into the space. And that was a big part of the thesis why we ended up investing in Waterloo.
Well, that's great advice. But so for the startup raising funding for the consumer product goods space, what's your advice for those people and how to run their business?
Well, one, I think you got to have a very close eye on growth versus cash burn. So for every dollar in business, what kind of revenue can you build into the company? And you got to really, really have a good sense of being able to deploy capital intelligently and efficiently, because at the early stage level, it can run out pretty quickly. I think on the consumer product side, it's also important to focus on building those case studies within certain retailers or certain markets before you really start turning the jet engines on and expand in a dramatic way. So I always encourage entrepreneurs to get into a small set of retailers or get one account that you can go into and say, have a proof of concept, maybe be in that retailer for several months and say, hey, our product is turning at X where our competitors are turning at a level below X. And then you can really build a case study and then take it out to other retailers to show that your product is really performing well. And that'll help limit the complexity of going too wide, too fast, and getting too much expanded distribution too early that you can't necessarily service. A lot of entrepreneurs as well, and this is part of the reason they're entrepreneurs and we're investors, is they're phenomenal at starting products and innovating and coming up with these incredible ideas that can catch fire. I think there's a balance there around entrepreneurial innovation versus kind of like strategic innovation. So as you think about what other areas you expand into, I think it's important not to jump on every innovation opportunity that comes to mind, but what can be an extension of the platform that you're trying to build. I'm an investor in a company called Vital Proteins that really is the leader in kind of the collagen market, collagen products, ingestible collagen. And they've done a phenomenal job of creating a platform around what started as a supplements business focused on collagen, but now weaving in that collagen theme and thread into beverages, into potential creamers, to other opportunities that can leverage this halo of what's going on in the collagen market. And they've been very successful at it.
Well, that's very good. So as far as the CPG industry is going, how do you see that evolving? Where is it going over time? Of course, there's a big shift to the new brands and the millennial taste, but what else is going on in this space?
I think people generally, the CPG industry and some of the areas we focus on is the better for you space. And so regardless of what's going on in the macro environment and people's personal lifestyles, they want to feel better, right? So you're seeing a ton of capital, a ton of consumer dollars being thrown into this better for you space. And so I don't think that trend is going to fall away. I think focus on whether it's better for you products that are coming out of Whole Foods that eventually trickle down into the other conventional channels, the club channels, or apparel that's more geared towards more of an active lifestyle, or anything that's kind of capitalizing on that trend is something that's here to stay. I think online, direct to consumer is another area more from a channel standpoint that's continuing to proliferate with the CPG world. So being able to go direct to your consumer from an investor standpoint allows for better economics because you don't have to pay the middleman as a distributor or give the retailer a cut. You're starting a one-on-one conversation with your consumer. And that can become a very sticky conversation because it's one-on-one. You don't have, in some of our businesses, Walmart, a big customer. And if Walmart shuts you down, you can have 30% of your revenue or bigger walking out of the door immediately. When you're going direct to your consumer, it's a one-on-one conversation. So it's more granularity around that revenue. So if you have one consumer fall away, you're not betting the bank, you're not betting the business. But it's just becoming an increasing part of how consumers are spending is jumping online and buying or going on Amazon.com and buying. And I don't think that's a trend that's going to go away.
Well, that's good to hear. So what's your investment thesis for CAVU Venture Partners? What is your criteria in particular that you look for?
Yeah, so we're really focused on this. We invest in companies that make you feel better, whether it's a healthy food or beverage product that sells at Whole Foods, whether it's a personal care product that sells at Sephora. What I always tell people is our firm is a bit of a topsy-turvy firm, but in a good way, in that our founders are all people who've actually really kind of started and built businesses. And then they've done a good job of surrounding themselves with more kind of deal-oriented professionals like myself. So we really focus on what we call strategic value-added minority equity. I mean, entrepreneurs at the end of the day hold the keys to these incredible success stories. Our job is really to help facilitate and advise along the way, help provide experience and advice from getting our hand too close to the fire. A lot of our portfolio is focused on food and beverage. So I think there's kind of like some domain expertise there where founders can really, especially in the food and beverage space, leverage our experience across 20 plus portfolio companies, as well as tap into those portfolio companies for a community and an ecosystem as they build out their businesses. And the capital is a big thing as well, right? You can use our capital to build that phenomenal management team that we can help architect. You can use our capital to expand in field marketing, to build distribution, all these things that lead to a great outcome. I think some of the common themes in terms of the investments we make is one, starting with a great product and ability to build a brand around that great product. We invested in a company called Chef's Cut pretty early on, and jerky is one of these categories that historically been known just to get a bad rap. Go buy it in the convenience store, and you don't really know what's going in your body. There's nitrates, there's all sorts of fillers. And Chef's Cut came out, and it's kind of a better premium, almost chef-oriented jerky, and can serve as the perfect in-between snack between meals, high in protein, low in sugar. And so we were able to take that product, which is a phenomenal product, and build a great brand story around it. So product with a brand or ability to build a brand is one of the key ones for us. Two is, to my point earlier, some proof of concept. The businesses we invest in are typically growing anywhere from 60 to 100% year over year. They're high growth businesses. And so if your business is growing that size, it's usually a pretty good indicator that it's a business that we'd probably look at it. But even if it's not, if there's something at the store level that shows that you're outperforming your peers within certain markets, that can serve as a leading indicator as well. So we invested in a company called Health Aid, which is a kombucha business. And when we invested in them, they were essentially in few markets on the West Coast in California. So they weren't known nationwide. But if you looked at their velocities at the store level, they were performing on par or better than the leading kombucha brands in the space, including GT's kombucha. So we kind of looked at that and said, if you extrapolate that across the country in terms of those velocities, that can be a pretty sizable business. So that kind of proof of concept is probably the second key tenet. And then the third for us, what really kind of differentiates us from other firms is we'll only invest in businesses that we feel like we can be helpful and really help affect the outcome, given our value add toolkit. So that allows us to be flexible in terms of the size of businesses we can invest in. We can invest as little as 2 to 3 million, or I've invested as high as 30 million. But it's really, can we be helpful to the business given our resources and toolkit?
Well, that's a great rundown of your investment thesis, and it sounds like you have some great segments to go after. For the companies that you work with, what do you think are the biggest challenges they face in starting and running their startup as far as regulatory, technical, or market issues that they face?
I think on the regulatory side, you got to be pretty focused on nutrition ingredient list that goes on the back or on the cover of your product, and make sure that's cleared with whatever the regulatory is, whether it's the FDA or in supplements, it's a different lane you're going in, but you have to be pretty maniacally focused about getting that right out of the box, because as soon as you start getting distribution and you start building a relationship and a trust with your consumer, product recalls are probably one of the worst things that can happen to a CPG business, because they're so brand driven and they're so trust driven. You got to get that stuff right early on before you go to market, and it's better to over focus and to some degree overspend on making sure it's correct before you get to 5 or 10 or 20 million of revenue and things become so complex and difficult that it's hard to go back and correct it. I think from a distribution standpoint, it's really important and this is more on the technical side, but understanding the landscape of distributors and relationships with those distributors, that you need to either go out develop yourself or hire someone who already has those relationships and can leverage them to help expand your product. Because at the end of the day, as long as you have the right product and you're thinking about marketing the right way, then it's all in distribution. And there's a pretty big moat that a lot of companies can have if they can build the right distribution channel for their product. I'm an investor in a company called Hybrid Coffee that has one of the best sales forces across the beverage land, the high growth small business beverage landscape. And they've really been able to use their Salesforce architecture as a high point of differentiation to build their cold brew coffee business essentially into the largest independent cold brew coffee business in the country. And they have a phenomenal product and a phenomenal brand, but having that technical side on having the right Salesforce architecture has played as big a part as well.
Great. Are there a couple of new sectors coming up in the CPG space that get you particularly excited? Just one or two that you can call out?
Yeah, I think we always a lot of times start with, and this is more on the food and beverage side, is ingredients. What are hot ingredients that are in the market or coming to the market right now? So we do a lot of work around things like Google Trends and leveraging some of the retailer relationships we have in terms of discussions around what are hot ingredients. We keep our own ears to the street as well. But some of the areas broadly we're focused on, one is matcha. Matcha has become a pretty hot ingredient. Starbucks has gotten behind it in a big way. We made several bets within our portfolio on matcha. We have I'd call it the Starbucks of matcha from a retail standpoint, called Chacha Matcha, that's on both coasts. It hasn't made its way down to Austin yet. Hopefully it eventually will. We have a few of our food or beverage investments that incorporate matcha. I'm on the board of a company called Rebel, which has a matcha product. Vital Proteins, which I mentioned, has a matcha offering as well. And matcha is playing on a broader theme around just clean energy, clean ingredients. And so in that regard, not only matcha, but yerba mate, I think, is an area that's really interesting. So we usually start with where's the ingredient focus going a lot of times, and what's our ability to leverage or play that ingredient focus. I think, as I mentioned earlier, some of the broader themes just around sleep, starting to look at the sleep category more and more actively, and how can you play that, whether it's from a wearable standpoint or ingredients or products that you're putting in your body or on your body to help with sleep deprivation or improve sleep. Some of kind of maybe the hardware or the different bed type opportunities that are helping incorporate better sleep. I think that's going to be a big area over the next several years as well.
Well, that's great to hear. It sounds like a lot of great things are coming up. In the last few minutes that we have here, what else should we cover that we haven't?
I think we covered everything, Hal.
That's great. Well, how best for listeners get back in touch with you?
Best, you can go to our website, www.cavuventures.com, or you can find me on LinkedIn, Badr Alam, BADER ALAM as in mother, and we can connect there.
Great. We'll put those in the show notes. Thank you for joining us today and hope to have you back for a follow-up soon.
Thanks, all enjoyed it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.